The Federal Reserve is front and center right now today, and what exactly are they looking for? What are they trying to achieve? Well, if you look at the mainstream media, you get one version, and if you look at what I'm about to show you, you're going to see it in a different light. I will bring you the details you need to know, and we'll stay away from all that fluff. How does that sound? All right, let's begin. First things first, I want to show you this. Because yes, they do try to achieve price stability and full or maximum employment, in their words, by the way. But there's more to it than that. Important wage inflation measure for the Fed rose less than expected in the fourth quarter. It was, a small difference. Instead of 1.1%, it was 1%. But at the bottom, they mentioned this. Employment costs increased at a slower than expected pace in the fourth quarter, indicating that inflation pressures on business owners are at least leveling off. So essentially, when we look at the employment cost index, that's something that the Fed is going to look at. They have mentioned this over and over again. It is not about the U3 unemployment rate that they are watching specifically. They look at other indicators. This happens to be one of them. And so, as you can see at these meetings, I watch all of the Federal Reserve meetings and I read all of the documents that they put out, the press releases. I look at all of their meeting minutes and look for key details. The one thing that Jerome Powell has been saying over and over again has been that wage inflation is a problem. We have to look here at wage inflation. He said this in 100 different ways, but that's the key indication. This is starting to slow down. So it gives them more reason to not have to increase interest rates further. They want to stop increasing interest rates as fast as possible because, of course, they want to stimulate a hyper bubble, a super bubble beyond anything we've ever seen. If you thought 2009 up until this point was a big bubble, we are in for a wild ride, let me tell you, because the Federal Reserve is desperately trying to reverse course. We'll see though. We'll see how they act. Then we can look at the next aspect here, because you're looking at unemployment not being matched up with the layoffs that are taking place. Mass tech layoffs don't signal a recession. Well, it is very important to see what's going on with not just the tech layoffs. This happens to be just another example. Amazon layoffs hit workers in robotics, grocery, health, and AWS divisions. The reason I mention this is because you have a tech company, but really the jobs within that could be anywhere, right? It's not necessarily tech jobs, okay? That's the point I wanted to make. And then it just breaks it down in terms of, the amount of jobs and then the percentage of that workforce, technology layoffs, looking at Alphabet and Amazon and Microsoft and so on, and how much of the workforce in the case of Alphabet and Microsoft, 6 and 5%, Salesforce 10%, and so on. So they're, roughly what we can look at as being, significant. It is significant, but it's not as if they're firing half the staff and the company's going to be gone tomorrow. No. Generally, we've looked at the stocks of these companies and they have just looked so strong. It is unbelievable. And why? Because the stock market loves firing. They love to fire people. That's the number one thing they look for. As soon as things are getting too expensive, the company's spending too much money, what do they want to get rid of first? Research and development, stock buybacks? No, they want to fire people. If they were to get rid of the stock buybacks, what would happen? The stock will go down. If they want to get rid of research and development, now suddenly Apple or Amazon, they're not going to have any really good products coming down in the near future, therefore stock goes down. We fire people? No problem, stock goes up. That's the way it works. And so the Federal Reserve doesn't necessarily look at how many layoffs are taking place. That's important. They do not look at that type of stat. What's the Fed telling us? The easing of financial conditions is what makes this coming Fed meeting, as you're watching this, it may have already happened, and press conference so important? Financial conditions have been easing since October on the back of what can be called peak hawkishness. Long-term yields peaked when the Fed stopped surprising markets with the promise of tightening and began pledging to stay the course they already had mapped out. But it was only in January that peak hawkishness flipped to easy financial conditions, with the Bloomberg US Financial Conditions Index moving into positive territory 3 weeks ago. This is what I showed you in the video previous to that one. Have you seen this already? Have you been made aware of that? If not, you got to subscribe to the channel. Every single day I bring you literally the actual tip of the spear in terms of all the data. All the data. Like if you want fluff, wrong channel, okay? If you want nonsense, political, whoever, who's doing what to who, and I don't even know, okay? I don't know any of the political stuff, except when it comes to the economic aspects. That's when I get involved in that. Okay, so what we can see here is that the Federal Reserve is trying to say, on one hand, we are going to bring inflation down. The statistics are starting to level off and they're starting to actually fall in many cases, the stats that they use. So they're saying we're going to be tough. Things are kind of coming down. They're trying to highlight the fact that they want to ensure that the 1970s style, first we're going to bring inflation down, we're going to do it so well, it comes down, then it just rockets back up because they didn't do enough. They want to highlight that this is not going to happen again, and yet the Financial Conditions Index has shown us that what we are experiencing is easier today than it was before they started the tightening cycle. This is how topsy-turvy these markets, these financial conditions really are today and now. And so what the Federal Reserve is going to pull out of their sleeve, I really don't know. So if I had to guess, this is recorded obviously before the meeting comes up, the estimation, and I've mentioned it multiple times, I'm going to stick with that, is a 25 basis points or 0.25% increase in the Fed funds rate. Whether or not they do that, we'll see. Some are saying 50 basis points to show how strong they really are, but I'm not so sure. A lot of the people in the Fed are suggesting 25 basis points would be what they would vote for. So that's the way it goes. This is important, right? Taking into the next aspect, you could see the GDP, because the Federal Reserve absolutely looks at the GDP. GDP report reveals ominous Great Depression warning sign not seen since 1932. And this comes out of the Bureau of Economic Analysis. And they say essentially that the economy grew by 2.9% in the fourth quarter, 2.1% in 2022. While the White House was quick to take credit for the state of the nation's economy, they might want to think twice. That's because basically the economic growth is slowing down, even in areas which contributed positively to the GDP, not necessarily signs of prosperity. And what I talked about was like the inventory levels had increased, but that's not a positive sign because people were not buying. They were not buying that stuff. Inventory, technically, that's stuff that could be sold. So it adds to the GDP, but it's not necessarily something that is positive, is it? Because they're not buying it. That's just one aspect. So they get into more here. But the point is there's a less growth happening. It's shrinking. 64% of Americans are living paycheck to paycheck. This is another stat. I mean, I've shown you around this range before. I've shown you in the 70s. It doesn't matter. Paycheck to paycheck, no matter if it's $100,000 a year, $250,000, people in general live paycheck to paycheck. That is a generalization, of course, not everybody, but that's the way it goes. So we can see that people's real disposable incomes are declining. If you want to look at this in many different ways, savings rates are down, credit card usage is up, the whole buy now, pay later is off the charts. All of these things add up, and those statistics are incredibly important to understand the real economy. That's what I bring to you here on this channel, The Real Economy. Hit that subscribe button so I can continue to bring that to you. China's reopening makes the fight against inflation even harder. This is a subject that I've been talking about in recent weeks. The reopening will provide a boost to global growth, offsetting this China's reopening, obviously, offsetting the weakness in Europe and a looming recession in the US. The catch, it'll also boost inflation. So we will see what happens. But apparently it could push up consumer prices. And you could see here China shock forecast for global CPI on different scenarios for 2023 China GDP growth. So depending on where China is at, this would have an impact on the global CPI because you're going to see China domestically purchasing things that will increase the prices of goods and services. Then those are exported to the whole world. That means higher prices. At the same time, you've got people in China that will spend money in other places, tourism, and just purchasing assets of all kinds around the world. That boosts theirs as well. So you could see that this has a great impact when they have potentially trillions of dollars because of a essentially three-year lockdown. They've got a lot of money to spend, and they've made it clear, like the stats are there, that they want to spend. So it's not as if, these are just random stats. They actually have made that very clear that they want to spend. And then I wanted to show you the fact that this isn't just the US and China and other places. We got to look at this all over the world. More Brits turn to Aldi and Lidl, I believe that's how you pronounce it, as food inflation hits record. Shoppers face an extra £788 on their annual grocery bills. Food prices stubbornly rise despite broader inflation easing. So the inflation rates have come down. I believe in the UK it's still over 10% though. But the prices that people pay on just about everything have risen considerably. And so if those are not going to come down, people are going to have to pay more, right? Those numbers are not necessarily so attractive, right? So we could see that for a lot of people, they can feel this burn for, the next little while. So what can people do? Of course, number one, they could try to increase their income as much as possible. These things can be done. You got to ask your employer for what they can do. Try to actually set a particular goal. If you are in a position in which you can hit certain levels, make that deal with your company. If I hit this and if I do this and this, write it down on paper. What will my compensation be? Maybe you get that as a bonus at the end of the year. All these things can be. It is possible. But what about, your own business? You could do things for yourself. Set up something on the side. Try to do your best. It might just be a little bit, but maybe it's enough to offset the rising costs. So that's it for today. If you found this message informative, hit that subscribe button down below so that I can bring you the latest and greatest tomorrow. Take care.